One. Hello, everybody, and welcome to another Smart Money Circle update. I'm Adam Sarhan. With me today is George Schultze, who's the founder and CEO of Schultze Asset Management with over 100 million in assets under management. George, thank you so much for taking the time and welcome to the Smart Money Circle.
Thanks for having me, Adam. Great to be here.
So, George, I always like to begin. Can you tell us a little about your background, your story, how you got to where you are today, please?
Sure. I'm a New Jersey native. I grew up in northern New Jersey. I was the youngest of 8 children. Eventually, I found my way to Rutgers College, where I studied economics and political science. Probably partied a little too hard early on, but eventually, come sophomore year and through graduation, I focused and pretty much a straight A student. I graduated from Rutgers with that dual degree, economics and political science.
Well done.
As a Henry Rutgers scholar. I see you smiling. Did you go there?
No, but my background's poli-sci. I have undergrad and a master's, and I'm from Jersey as well. So we'll talk about that afterwards, but by all means.
Okay, great. Well, I was lucky because, after focusing, it gave me, really good grades, and being Henry Rutgers scholar gave me the opportunity to go to Columbia Law School. So I applied and got into Columbia Law School. I was excited about that. When I applied to school, to graduate school, I wanted to do a JD and MBA program combined. And Columbia, it was a little difficult to apply early on to the MBA, but once I was in the law school at Columbia in Manhattan, I also applied to the business school and got into that program too. So it was a 4-year program where I earned the 2 degrees. And it was just great. It was a great training ground for what I eventually wound up doing in life. When I graduated from Columbia, I went on to work with a pretty big hedge fund called MD Sass, founded by Marty Sass many years ago. And, it's funny, this is actually a long time ago now. So, having started my firm after that, it's been about almost 26 years ago now since I left MD Sass and started Schultze Asset Management for my clients. And now I have a large family of my own. I've got 6 kids. I live in Rye, New York, in Westchester County. And, I just love it up here. Enjoy playing squash a lot, enjoy kiteboarding and, playing a lot of chess, especially against my kids who have, a number of them have become really good. And that's pretty much my story.
I love it. I love it. I love it. So let's talk about your investment strategy, please, George. And how do you play the game, so to speak?
Yeah, so it's a very interesting investment strategy. And it's one that sort of keeps me very motivated, even after having done it for nearly 26 years. I love getting up and, doing the work that goes into trying to find really market inefficiencies. And that's what we do at Schultze Asset Management. We invest before, during, and after distress for, in U.S. companies. So when companies are headed into trouble and our forecasting and modeling shows that they're likely to get into more trouble, we look to short sell the stock of those companies. And it's not just, bad quarter or bad earnings or something like that. It's these companies are troubled. They're going into potentially bankruptcy. They have too much debt and the situation's getting pretty bleak. So we short sell those types of companies. And then later, once the companies are distressed, often when they're in bankruptcy or when they're on the verge of filing for bankruptcy, that's when we kind of change our view and look to maybe buy into the distressed debt of those situations. We try to buy the debt issued by those companies at pennies on the dollar. And what we're looking for there is creating eventual ownership of those same companies at a discount by buying the debt that they've issued. And there's an interesting arbitrage there. I'll talk about it in a few minutes. But that sort of leads to the last of 3 trades that we do here at Schultze Asset Management. And that last trade is we buy or own, if we got it through their distressed debt, we call it post-distress equity, or equity issued by companies that previously restructured and hopefully eliminated a lot of debt through some sort of process, like a restructuring process or even a bankruptcy process. At its heart, it's an attempt to find market inefficiencies. And the easiest way I can think of to explain it is to think about it as an arbitrage where you have a certain type of mentality and market outlook in the fixed income market where lots of certain types of investors play, be it CLO funds or mutual funds, and even insurance companies and banks. They're lenders to companies. And then you have the stock market, which, really has a whole different type of, investor. And, between the two, most of the time, stockholders have very little appetite to own debt, and debt holders have very little appetite to hold stock. So especially on that side, when you have distressed debt that's trading at a very sharp discount in a company where maybe it's defaulted or has had a big ratings downgrade, those lenders, those former lenders who bought the original issue debt often become forced sellers, because at a certain point it becomes sort of inevitable that that debt will be converted into new common stock. And that's the arbitrage that we're looking for.
I love that. So just to explain to the audience and recap, as you're looking for there's three steps to your process. You're looking for companies that are in distress, or they're going to go bankrupt, or they have issues from an accounting standpoint or fundamental standpoint. Then you short the stock. Stock goes down a bunch. Hopefully you're right, if your thesis is correct. And then you exit the short. And then the company goes into that restructuring. They get rid of a lot of the bad stuff that caused them to go down. Then you're going to buy the debt. You're buying the debt, not the stock, in that phase, because the debt has higher priority than the stock, and the stock's pretty much wiped out at that phase. Is that correct? And then
exactly, but it's important to know that they're not always the same companies. What I've described there is a cycle. A cycle of a corporate restructuring. Companies will go through that cycle during normal times. It doesn't always happen that they're normal times, by the way. Sometimes the government gets involved if there are systemic issues happening. Like after COVID hit, the government, tried to bail out as many companies as possible by making money, basically free, and drove interest rates down to nothing. And in another big cycle after the great financial crisis, there were bailouts by the government of certain companies. And so, during normal market environments, that's what happens. And again, though, it's not always the same company that we're looking to short and then eventually take a long position in. But that's the cycle, yeah.
That's great. So thank you for clarifying. I thought it was the same one where you just write it out all three stages. And then after the debt, then you're looking for companies that are coming out of bankruptcy and or have restructured, and their stock is now cleaner. And a lot of the bad stuff that caused them to get distressed in the first place is gone. And then they have a chance to go back up.
That's right. But there's something really interesting about the first part of that puzzle of those three trades. You would think it's pretty well known and pretty well understood. Companies go into bankruptcy. Of course, their equity holders are going to get wiped out. But there's still a very interesting market there. Lots of investors don't play in that, and it can become difficult to borrow those shares. Sometimes they become heavily shorted, and you see short squeezes. In the last big cycle, they called them meme stocks. But it's a very interesting market, because in almost every case when a U.S. company goes into bankruptcy, shareholders get nothing. But sometimes the route to getting nothing can be chock full of volatility, and the stocks can sometimes go to multi-hundred million or even billion-dollar valuations, like we saw in the last in the last big cycle post-COVID.
I love that. So that's a really interesting way of looking at markets, and there is several levels of arbitrage there too. You are bringing the fact that most people aren't even looking there to begin with. So I think that itself is
right. And interestingly, the biggest institutional investors generally don't do that short selling, because it's not something that you can do with unlimited capacity.
correct.
So, as we said earlier, we have about $100 million in assets. If you have a $30 billion fund, just imagine how much capital you'd have to put to work if you want to put 10% of it into these types of plays. It's just not feasible. It's very difficult to get the borrow with certain of these companies. But if you're more nimble, you can short sell those companies, and frankly, it can also get you up to speed on industries and themes and companies before all the other distressed debt players are focusing on them.
Yeah, no, I love that. Okay, beautiful. So let's talk about risk. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
Yeah, now that we've spoken about shorts, I think probably the most obvious one, that I think about when I think about risk is, lots of people are unwilling to let go of losing positions. And I think that's probably, the biggest mistake in risk management. The markets are somewhat efficient, actually pretty efficient, I would say. you can find market inefficiencies, but, I think you have to respect the market and be prepared to get out when things are going against you, because sometimes long trends form and, they just go on longer than anybody would have expected. And there are lots of examples we can think of, when you think about that. For instance, the fixed income bubble that we're just starting to come out of now lasted for over a decade easily. So sometimes these trends continue for a long time, and even if you're doing an intense amount of fundamental due diligence and research, even if you have a very definitive view, and even if you're right, sometimes you can lose a lot of money by waiting, for that investment to work out. So I think that's the biggest mistake people make. They don't get out of underperforming things.
Wow, that's really good. So do you use stops to get out, or do you use mental stops or X? Like, in other words, my question is, when you enter a position, do you say, hey, if it goes against me by X%, I'm out? Or do you wait for some fundamental data to show up before knowing that you're quote unquote wrong?
Yeah, we try to do it more the former. If a position is against us by 10% or so, maybe even less, 8% from its high water mark up to 15%, we're trying to cut those positions out, as soon as we can out of the portfolio here at Schultze Asset Management.
Okay.
And, it's not really a stop loss, because some of these securities that we trade on the short side and also on the distressed debt side, you can't just put in a stop loss order. That you've got to manage them and manage them more. There's a certain level of human touch to get the best execution and get out of those positions, as a trader when they're going against you. So you can't just put them in the box and forget about them. But yeah, we try to cut them as soon as we can. We think of them as a percentage of loss, so sort of anything less than 15%, that's sort of the maximum we'd like to see before we get out of a position that's going against us from its high watermark, not from its cost. So for example, if a position goes up to 100, we'll be, and it's been a profitable position, we'll start getting out of it as it gets down to 85, and then, probably liquidate most of it by the time it gets down to 85 if it was going against us. Same thing on the other side. If it's a short sell, just do it all in reverse.
I love it. Okay, beautiful. And what are some timeless lessons you've learned along the way, George, that you'd like to share with the audience?
Well, I think that risk question is probably the most important. Maybe just thinking about that a little bit more, being patient. I think with regard to distressed companies, it's very interesting because lots of these companies can have multiple events along the path of their distress.
Right.
As they go into distress, there might be, some news event that says, where reporters start saying, hey, this company is facing risk of bankruptcy. That might be an event that's worth watching. But then there'll be future events also. So basically it means that you have lots of different bites at the apple. Because a company going through distress, doesn't just find itself in bankruptcy one day. First it'll have a default, then there'll be a grace period where the lenders give it automatically, usually 30 days or so, to try to work things out. They may stop paying interest on bonds, or they may have a covenant violation on their loan agreements. So there are lots of different things to look for, and so I think that's probably one of the most important lessons, just all the different opportunities to place a trade on a company that's going through this cycle.
Got it. And then what about timeless mistakes you see people make, and how do you avoid them?
Timeless mistakes?
Yes.
Yeah, so that's what I was saying earlier, with getting out of losing positions. This just happens time and again in the capital markets, and it happens both with short selling and with long positions. People that lose a lot of money usually lose money because they're unwilling to let go of something that's not working. They become convinced, and it's a human bias, really. They become convinced that they're smarter than the market about something, and the market just has it wrong. And the problem with that is they might be right, but the time, to get there might take longer than they expect. And so, I think the most important thing, as I said earlier, is just getting out of losing positions as soon as you can. Here at Schultze Asset Management, we do it every day. There's an interesting book I read recently called The Best Loser Wins.
Nice.
And I think that's true. In investing, if you can cut losses quickly, you're a good loser, and you're able to redeploy your capital to the better performing trades. It's almost like Pareto's law. For most money managers, even the best, a very small percentage of all their positions are profitable. If you believe that, and you have to because it's been proven, then that also means that most of your investment positions will be flat at best. If not, many of them will be losers. So getting out of that losing inventory as quickly as you can and redeploying capital to things that are performing, in other words, letting your winners run and cutting your losers as quickly as you can, is really the most important thing. And you've seen it time and again in markets when people hang on to things. Some very big cases, like you saw with Ackman a couple of years ago, with I think it was Herbalife. Just time and again, that's usually what causes portfolio managers to have trouble.
Yeah, no, I couldn't agree with you more. So I wrote a book about investing. It's called Psychological Analysis, George. It's our first time meeting, and it was #1 on Amazon for 2 months. And in it, I have a whole bunch of cognitive biases and a whole chapter on risk management. And I love it when guests come on the show and basically reiterate or re-emphasize the importance of everything that I've discovered on my own journey for the last 25 plus years. And I watched a documentary about Yogi Berra, since I don't know if you're a Yankees fan or Mets fan, but the Yogi Berra, the famous Yankees player, and phenomenal success in his own right. Baseball players are all like traders, where most of their swings are going to lose, right? The best baseball players in the world, if they hit 3 out of 10, they're loving life. And the same thing with trading, but most traders go in, they're thinking every trade is going to be the biggest home run and grand slam, and it's just not the case. So people looking at the reward side of the equation, they're missing the risk side. And to your point about cutting the losses and keep letting your winners run, I've just noticed successful guests over time, over 5, 6, 7 years now, have reiterated that same golden thread of like, listen, if you want to win, I love what you said about being the best loser. That is so powerful.
Yeah, well, I'd love to. I'm going to get a copy of your book. It sounds like a great read, and it really is true. But it is, it's contrary to human nature, especially for people that do fundamental analysis. And what we do is like deep fundamental analysis, because we look at distressed situations. So it takes a lot of time. Often it uses, my legal background as well, and so it's even harder. But if you stick with that and you think about that as the most important thing, I think you really do have an advantage in the market.
I love that. So let's talk about advice. What's the best piece of advice you'd like to give to the audience in or out of the market, in life, however you want to go, business, or what's the best piece of advice you'd like to give to your 30-year-old self, please?
My 30-year-old self, I wish I was 30 again.
You and me both.
I'll be 54 soon. I think that discussion about letting getting losers out of your portfolio quicker is important. And it makes me think of an example from a couple of years ago when we got involved in the Chrysler bankruptcy. We invested long in the Chrysler Automobile Company distressed debt, and it looked like a great position. But in that case, politics got involved, and the president of the United States announced the bankruptcy and the restructuring plan, which was that had never happened before, where the lead politician in the United States declared bankruptcy for an automobile company, or any company for that matter. Unfortunately, what came out of that was a different priority scheme, for the Chrysler creditors than had occurred with almost every other bankruptcy up until that point. And that caused us some losses. And really that same rule would have helped, getting out of a position like that even more quickly would have helped. But thinking about, just advice for, everyday life and for others, I would say it's really important to love what you do in terms of work.
Yeah.
And I don't remember who said it, but, it's often been said that, if you really love what you do, you never work another day in your life. And I think that's true. So I would advise people, to spend the time and think about what it is they want to do. And then, it'll be fun for you if you think about it carefully that way.
Absolutely love it. Well, George, thank you so much for coming on the show. What is the best way for people to get in touch with you or learn more about your company and what you do?
They can just go on our website or, Google Schultze Asset Management. They should be able to track us down that way, or via Bloomberg.
Beautiful. Well, George, thank you so much, and hopefully we'll have you on again soon.
Sounds great, Adam. Thanks for your time today.
Likewise.